Hey everyone, this is Brandon Rush. Thank you for joining us for another episode of The Agent Investor. The goal of The Agent Investor is to have conversations with those involved in commercial real estate, multifamily real estate, and to help you guys make informed decisions. So today we have a good friend of mine, Ashleigh Martin. Ashleigh is the founder and owner, CEO, all the above of AEM Accounting. Thank you so much for joining us, Ashleigh.
Thanks for having me. Excited to be here.
Yeah, absolutely. So, how Ashley and I know one another, actually, that's a good question, how we know one another. We go back probably, how did we meet? Do you remember?
So, the first time we met was a couple of years ago, probably like 2 years. Our friend Tom Palovi introduced us when you started your monthly meetups and you
Oh,
wanted to have an
yes.
accountant come in to talk.
Yes, you were a sponsor for the event, and here
Yes.
we are, 2 years. Yeah, time was fast. So, all right, cool. So that's how I know Ashley. See, I sponsor an event here in Connecticut, and Ashley happened to be a sponsor, and now she's currently a sponsor, and everything worked out, and we're still here. So, all right, let's get to it. So, Ashley, tell us a little bit about yourself, about AEM Accounting. Tell us about your background. Just spill it. Go
Yeah,
for it.
definitely. So, I went to CCSU. I graduated in 2008 with a degree in accounting. And from there, I jumped right into public accounting. So, worked at a smaller sized regional firm in Glastonbury, which got bought by a bigger firm, which got bought by a bigger firm. So 15 years later, I was still at this big accounting firm working on large audits of nonprofits. And I started to notice that small businesses, individuals, and smaller nonprofits were no longer getting serviced by the bigger firms. Either they couldn't afford the services or bigger firms just didn't want to take on such a small project. So I saw a giant need in the industry. So this year I decided to pack up my bags with my trusty calculator and start AEM Accounting. So we focus on individuals, small business, and small nonprofits, and we can handle all of your accounting and tax soup to nuts. So if you need a bookkeeper, we can take care of that. If you have a bookkeeper or you do your own bookkeeping, we can kind of come in and do the higher level accounting stuff where we could reconcile your accounts, put together your financials, help with cash flow, budgeting, all of that. And then we can take it through to do some tax planning strategies, tax saving strategies, and prepare your tax returns.
Absolutely. Very good. And to give context for why I'm attracted to Ashley's service as an investor in multifamily, that's just one more thing to kind of offload at some point because the TurboTax only goes with so far. Once you're buying investment property, as we'll talk about, there's many more aspects and layers to how you handle your finances. And it's best to hire professionals sooner than later so you're not caught years in owing significant amounts of money and going through all this chaos and hating what you're doing. So what we're going to talk about today, we're actually going to talk about property ownership and tax considerations during different phases of ownership of property. So we're going to talk about the acquisition phase, which is, preparing to buy a property, going into while you're buying a property, things to consider regarding taxes and financings. We're also going to go talk about the management aspect of, or the ownership aspect of where you own the property and operate the property. And then finally, we're going to talk about the disposition of when you sell the property leading up to the sale, after sale, things like that, and considerations for that. So let's dive right into it. We're going to start, it's a very general question, but when we are looking at the acquisition phase of purchasing, would you rather it be specific to a multifamily or commercial property, or what do you think is the best way to proceed?
I think maybe for these purposes, we do residential,
Okay, got it.
multifamilies.
Got it.
We
So
can
what?
have a separate conversation about commercial.
Okay, perfect, perfect. So we're talking about residential. This really can apply to 1 to 4 units since
Yep.
it still could be rental property, all that good stuff at single units. What considerations or what should investors start to think about as they're considering buying their first or buying their next investment property, multifamily?
Yeah, definitely. So one of the biggest things is not just with taxes, but your cash flow and your cash availability, which is going to help determine if you're going to pay for it upfront in cash or if you're going to finance it. Now,
Hmm.
if you finance it, your mortgage interest is going to be a tax deduction on your Schedule E. So that is something to consider is you might have to be paying a little bit more in the long run because you'll be paying for interest on your principal, but that is going to reduce your taxable income. Other things to consider is, kind of track your expenses for looking at the property, because you can deduct the commission for the real estate agent. You can deduct a lot of the expenses that you're incurring for your research, including your travel. So keep track of your mileage, because that's a tax deduction that we'll talk about later in the segment.
Got it. Very good. All right. That's it for now.
Yeah,
Okay.
in the beginning stages, there's not a whole lot that you can do to save on taxes or that are really going to be incurring. But your biggest one is determining if you're going to be buying via a loan or cash.
Got it. All right, cool. Very good. Yeah, I did think about it, especially once you buy a few, you kind of understand, but definitely in the beginning, I don't think a lot consider the amount of time and money that goes into searching for these properties. I mean, me buying my first property, I probably spent 6 to 8 months looking for that property, spending lots of money, losing money and inspections and things like that.
Yeah.
So it's definitely good to, at a minimum, track those expenses as you're looking to acquire property.
Them if you feel comfortable, QuickBooks Online is a great option. You can also do things in a notebook, in Excel, save your receipts, but it's always a good idea to have everything tracked so that you do have a record of it.
Got it. So I do have a question. With that said, if I did spend a lot of money searching for a property, but it wasn't necessarily, when I found that property, it wasn't the one that I spent a lot of expenses on. Like say if I went through 2 inspections and that cost me $1,200 and then a lot of driving, is there any way that can be factored into that year's taxes as business income? I mean, if you have.
So if you are a real estate investor and that is a major source of your income, all of those expenses are considered business expenses that you will be able to deduct when the tax time comes. So you do want to track all of that.
Got it. And if someone isn't a real estate professional, say if they have a full-time W-2 job that isn't real estate profession, are they able to capture any of those expenses that are not tied to the property they purchased? Yeah. Okay. Perfect. All right, cool. All right, so we're going to move into the operating aspect of owning a property. Where we are now, we've sourced the property, we've acquired the property. Now we are currently in ownership. What does that look like? What do we need to consider?
So here's where we can save you with a lot of taxes. So all of your operating expenses are deductible. Again, we need to make sure you really do a great job of tracking them. We'll talk about why when we get to common mistakes that real estate investors incur when it comes to tax time. But any sort of operating expense, your landscaping, your pest control, all of your repairs and maintenance are going to be tax deductible. If you are paying for common areas for like gas, electricity, all of those can also be deducted up to a certain point if you are house hacking. If you buy a 3-family and you have it fully rented out and you're paying for the hallway lights, the front door lights, we can deduct all of that. We can deduct all of your landscaping, all of your pest control. But if you're house hacking and living on the 3rd floor, we can only take a percentage because this is also considered part of your primary residence. Another tax deduction is going to be your mortgage interest that we had talked about when we were buying the property. Depreciation. Depreciation is a big one, especially when you first buy the property, because the depreciation is going to come up front and go through a certain number of years depending on the property and asset type. So for the building, it's 27 and a half years that you get to deduct and depreciate that expense of purchasing the property. If you buy appliances, those are also depreciable by 5 years. A new roof can be deducted for depreciation for 15 years. So one of the big things I recommend is when you buy a property to have a cost segregation study done, which can be pricey depending on the company you go with and the size of the property. But again, it's tax deductible. And it will get you to segregate all of your different categories since each category is depreciable by a certain number of years. Land, you can't depreciate whatsoever. But the cost of your building can be depreciated, and your leasehold improvements and all of your appliances. So this company would go in and determine if you purchase something for $300,000, how much of that $300,000 is the land? And we would back that off because it's not depreciated. It would come to that $300,000, how much is the actual building? And that's depreciated at 27 and a half years. What is the appliances at 5 years? Your leasehold improvements, depending, could be 10 to 15 years. So this company comes in and determines what is going to be segregated for that depreciation area.
Got it. And question, so with that depreciation, just to kind of dumb it down a bit, because there are
Yeah.
multiple lifespans of things in that depreciation period. Like you mentioned, appliances may be 5, where a roof may be 25, 30 years. How does that translate into someone's profits or their taxes? How does that all tie in together?
Yeah. So your Schedule E on your taxes, if you are an LLC sole owner, you will have your rental income and all of your expenses will be deducted. Now, cash wise, you're going to have $50,000 of rental income, let's say for easy math, and then you have $40,000 of expenses. So cash wise, you made $10,000 on your rental property for the entire year. For taxes, you'll have that $10,000 of profit in there, but we'll also take depreciation. So a lot of times in your first several years, because the smaller items are being depreciated at a higher rate, you could have a tax loss. You could come down to having a $5,000 loss because your depreciation on everything was $15,000 and you had a cash gain of the $10,000. As you go throughout the lifespan of your property, your depreciation is going to shrink because things are going to fall off. So you will have taxable income. Your depreciation also might bring that taxable income down to $5,000. We can't guarantee that it's going to knock out all of your profit to be down to zero or a loss, but it does help you substantially, especially in the beginning. And if you do an upgrade or purchase assets for that property as you own it, those will be added in for depreciation. So let's say the dryer kicked the bucket, time to get a new one. The new dryer, if it's $2,000, is going to be depreciated over the next 5 years.
Got it. So it's depreciated on the schedule. And sorry if I'm asking this correctly. So say if you have the roof that's 25 years, but you have a stove that's 5 years, every year, so say if it's 5 years, that's 1 year out of 5 that's depreciated. And then after 5 years, that stove, in very simple terms, is fully depreciated.
Completely depreciated. So on your tax return, it will be your schedule of depreciation, which rolls into your Schedule E. So by using a tax preparer, we have in our tax software, we set up your assets, and the system will keep track of the depreciation every year. And once it gets to zero, it's no longer depreciated.
Got it. And I know we're sticking with the residential multifamily, but sneaking into commercial space, say if this was a larger apartment facility, say 20 units, 20 apartments, is it the same kind of schedule in a sense where it's 5 years for the stoves that you may provide tenants? Okay, got it.
Yeah, so for larger scale apartment buildings that are more commercial, it's all going to be the same.
Got it. Understood.
With that being larger, you just might not be an LLC. There's probably more tax advantages to make you a partnership or an S corp.
Got it. And that'll be something for another time for us to dip into with it before we start going off. All right. So those are considerations when we are in the operating or management mode of a multifamily or residential property. And from me being an owner of property, I could definitely appreciate being able to have someone like Ashleigh. And this is not selling her. This is really just general. It's good to have a resource like her because there's a lot of things that go into, you can easily forget. And if you don't have a check-in with someone, whether it be quarterly, twice a year, whatever it is, or someone like Ashleigh, you tend to forget or miss out on savings that you could be taking advantage of. You could have went through major improvements or discussing is it better to replace a roof now or next year or whatever it may be based on what we did tax-wise. So for me,
and there's tax deductions that a lot of people don't even think about. Besides your owner expenses, continuing education, membership and dues to CT RIA, we can deduct all of that. Travel, if you are doing your own property management, we can write off some of your mileage traveling around to take care of all of your properties. For purchasing new properties, if you have a home office deduction, which is solely used for the real estate business, we can give you a home office deduction as well.
Got it. Very good. All right.
And
exciting.
The great thing about real estate is if you have a Schedule C business, that revenue is subject to FICA, which is your Social Security and Medicare. So if you own the business yourself, you are paying both the employer side and the employee side, which comes to 15.3% of your profit is being taxed for Medicaid and Social Security. But Schedule E rental properties are not subject to that FICA.
Oh, I did not know that. Oh, okay. All right, very good. All right, so we're moving pretty quick here, but good pace. So we're kind of transitioning from the ownership or management cycle of property ownership to the dispositions. What are some of the considerations as we prepare to sell, and then also as we sell, after sale, post sale?
Okay, so when you sell, you're going to be subject to capital gains tax. So what's going to happen is your depreciation from all of these years is going to be recaptured. And based on your various tax brackets, you could be taxed up to 25% on that recapture. Again, it's based on your tax bracket and your tax situation. So to get a good handle on that, your CPA would be able to give you a good idea of what that would look like. In addition to the depreciation add back, you're going to be subject to long-term capital gains. So what would happen is you would take the total sale and you would back off the cost of that property. So let's say at the end of the day, you had a $100,000 gain. That's going to be subject to a capital gains tax, which will either be 0%, 15%, or 20%. Again, that percentage is going to be based on your individual tax situation and your tax brackets. One way you can defer the tax is a 1031 exchange. I always like to caution people, it is to defer the tax. It is not to make it go away, because while you're deferring it by purchasing new property, it will eventually catch up with you. You will have to eventually pay taxes when you leave that 1031 exchange system. That's a very big takeaway. I see a lot of clients come to me after 20 years of doing 1031 exchanges, and now we are starting to add back all of the taxes that they were deferring for those tax years. And they can get a little upset because they weren't realizing that it's just a deferment.
Got it. Got it. And from my understanding, I mean, and sometimes it's not the best idea to 1031 because you could be losing money in the long term because you're taking a bad deal that doesn't really benefit you in the long run.
Exactly. You really do, for those, need to discuss with your CPA, tax preparer, and a real estate expert to ensure it's the right move for you. Don't just make the decision on a whim thinking you're going to get away tax-free. It could end badly where you could have recouped some losses, or which most likely will happen is you're going to have to pay some long-term capital gains, which have been accumulating throughout the years.
And not to cut you off, but a lot of owners I know, they default to think that 1031 is the way to go, but also they don't realize they've put a significant amount of money into the property and improvements over the time so they owned it. Some have over-improved the property to the point where their capital gains is not as steep as they think it is. They have to look back. But
Exactly. Improvements do, when you add them all back in, do help bring your cost basis up so that your gain and taxable amount will be much lower than what they actually think is going to happen. When you go to sell the property, you have to remember too, there's the sales expenses of your attorney's fees, your commissions to your real estate agent, and those are all going to help to bring down your taxable liability.
I'll let you keep going. Anything else there?
No, I mean, when you sell, there's not a whole lot. It's pretty similar to when you buy.
Yes, got it. All right, no, cool. So far, so we've covered the three different phases of property ownership: the pre-acquisition, kind of when you're scoping out property, offering things like that during that phase; actually when you own a property and manage and operate one; and then when you dispose of a property and you sell. So now we're kind of winding down, but we're going to jump into the next question. What are some of the common mistakes that you've seen real estate investors make during any of these phases of property ownership, and how can they avoid some of these pitfalls?
Yes. So one of the big ones isn't necessarily for tax purposes. It's more of asset protection, is entity selection. I see a lot of real estate investors come to me where they just have the property in their name, just as a sole proprietor, collecting rent, having their expenses go out the door, and being taxed on their profit. But what they don't realize is if they made the switch to an LLC, which still keeps them as a Schedule E on their 1040 and doesn't incur the schedule or the S Corp tax returns, you are setting yourself up for asset protection because you would be then considered your property a limited liability company, which separates the property from you personally. Meaning if something happens in your property, they can't come after you personally. They can only go after that LLC. So that's one of the big ones that doesn't have a lot of tax implications, but a lot of people don't understand that. And I have to coach a lot of them through when we're doing their taxes of, hey, this is really opening you up for liability issues. The biggest one that I see for tax-wise is operating agreements not being put in place. So if you are a partnership or an S Corp, it's a little bit different. But as an LLC, if you purchase a property with somebody who is not your spouse, you really should have a legal operating agreement. I've had several clients in the past who come to me where they buy a rental property with their boyfriend or their girlfriend or just a friend, and now we have to sit down and determine who's going to claim it on your taxes. Are we going to take everything 50-50? Do we take it based on who put the money in, based on who was doing the work? There's so many different nuances that during those 4.5 months of tax season, you don't want to be battling that out with your CPA. Or if your partner has a separate CPA, everybody in the mix trying to figure out what to do. You really should sit down before you purchase the property and sign on that dotted line in operating agreement to determine everybody's interest and how it will be handled for our taxes.
Got it. Absolutely.
A lot of people don't think that. They're just thinking, oh, I'm going to buy this with my girlfriend and it's going to be great, which it does turn out to be great, except when it comes time to do your tax return.
Oh, yeah. All the headaches in between. Yeah. Oh, very good. Oh, cool.
Failing to report all of your rental income. This one's a fun one. People think that if they just got some cash, you really don't have to report it. And you really should report all of your rental income. When you go and make those deposits in the bank, people there will start to see the money coming in. So if you are to be audited for taxes, they can go back 3 years and audit. But if you didn't claim your revenue and you were hiding it, it could be considered tax evasion, which has no statute of limitations. So they can just go back forever. And if you're collecting $600 of cash rental income every month for 10 years, they're going to want their taxes on that. So I recommend you always report all of your rental income. Fun fact, the IRS does have a tax code that says you need to report all of your revenue from illegal activities, including drugs.
Okay.
People don't realize it. It's stated right there in the tax code.
Yeah, no, absolutely. So there's a lot that goes into just things to remember, and just taxes alone. That's just one aspect of owning multifamily, but taxes alone, yeah.
Yeah.
Got it.
Failing to keep accurate records. Another big one. You want QuickBooks, you can reach out to a tax preparer. A lot of them are able to help you kind of set up QuickBooks. Wave is another accounting software that's a good resource for people. If you want to use an Excel spreadsheet, I have templates that I give out to clients all the time. But it's really important that you keep accurate records. This will protect you if you do have an audit in the future. You want to be able to support all of the deductions you're claiming. You don't want the IRS to think that you made something up because you did not keep your records. I personally have to keep copies of the records you provide to me for 3 years. I do recommend people on their own keep them for a little bit longer. Claiming property that is technically not rental income. Again, house hacking. This is another big one now that house hacking is becoming a big thing in the investment property world. A lot of people will claim their rent from maybe floor 1 and floor 2, and they're living in floor 3, and then try to claim 100% of all of the deductions. Technically, we can only take a percentage. So square footage, if the 3rd floor is the biggest apartment, you're going to have the biggest piece be considered personal. So you do want to have that in the back of your mind. If you're house hacking, you can't claim your personal portion or your personal utility bills as part of your tax deductions.
Got it. All right. All right, cool. So a lot to take in there. This is just a preview of Ashleigh's operation and what someone in her role can help you guys or help guys, ladies, investors, all of us in this world of complexities. And this is just one way to kind of offload that complexity so we can focus elsewhere and acquire more property and operate our properties efficiently. So thank you for that, Ashleigh. So we're going to start to wind down here. So we're going to get away from the CPA and finance questions and get a little into your business. So when you're not running AEM accounting, what are some of the things you enjoy doing?
I really like to read. I don't have a TV, actually. It was not turned on for 3 years and just collecting dust. I was like, it's got to go.
Yep.
If I'm home, I'm reading. I'm not home a lot. I like to, go out hiking, try new restaurants. I was an Irish step dancer for many, many years, so I still really enjoy going to the adult classes and keeping up with that and having fun with it.
Very good. Very nice. Well, that's cool. Ashleigh, how can people find you and or get a hold of you?
You can check out my website, which is www.aem-accounting.com. And there you can fill out a contact us form and somebody will get back to you within 24 business hours. Or you can get the phone number and email address right there from the website. But if you follow our Instagram, which is just AEM Accounting, we are always uploading tax tips, tax talks, accounting tips and tricks to help you throughout your business.
Very good. And last but not least, do you have any final words for our audience before we depart?
Final words of advice from an accountant for this is have a separate bank account for your rental properties. All of your rent can go get deposited into this account and pay all of your property expenses out of this. So if you're not using a QuickBooks or a Wave system, you at least have bank statements to substantiate what your property rentals were doing, and you can kind of gauge what your revenue, profits, expenses were throughout the year. And you can take a draw for yourself, so you can write yourself a check for your portion of the revenue that you want to use personally. Do not mix your personal and business banking.
Oh, very good. All right, everyone. So we're going to wrap this up. Ashleigh, thank you so much for joining us for another episode of The Agent Investor. We want to wish our audience the best in their health and happiness moving forward. Once again, Ashleigh, really appreciate you coming through, dropping all this knowledge, sharing. I know this is just like the tip of the iceberg of things that you can cover, so we'll definitely have to follow up on different topics at different times, but you're appreciated here. Thank you so much.
Thanks for having me. I look forward to hearing from the audience in the future at some meetups or reaching out via Instagram.
Absolutely. And to our audience, thank you once again. We'll catch you on future episodes of The Agent Investor. We'll see you on the next one.